And as the year winds to a close, many stock market watchers are looking back at 2015 to see which stocks had really lousy years, underperforming their peers. Dominic Chu takes a look at these misfit stocks and whether their luck may change in the new year.
Many stock market investors are already taking a look at whether the current environment has created potential bargains. In other words, which stocks that have fallen out of favor could be the big winners next year. Think of them as the misfit stocks, the ones cast off by investors. Now, the most notable place in the market for those misfit stocks is the energy sector, by far the worst performer in the large cap S&P 500 index, losing a quarter of its value for those energy stocks in 2015. But are there parts of the beaten up sector that could now be value plays?
We see value in the part of the energy sector, the refining and marketing. All those are going to do fine. And don't forget, there is a potential for an upside surprise if we get any type of demand growth in 2016.
It's not just about the negative sectors, though. The year's best performing large cap sector is consumer discretionary, which encompasses everything from retailers to movie companies and TV companies. That group, that sector, is up 7% as a whole, but companies like Gap stores, also Michael Kors and Macy's and other retail stocks have been lagging behind. And that's leading some experts to look at it and other parts of the market for potential bargains.
I do think companies that are inexpensively priced, low PE ratios, low price to sales, and that pay generous dividends are where you want to be heading into 2016.
Generally speaking, there is more cautious optimism about potential market returns next year. While the bears will point to considerable headwinds like the possibility of slowing economic growth globally or the strength of corporate earnings and geopolitical risks, that's just to name a few. Some of the bulls think that 2016 is shaping up fairly well.
This time last year, valuations for stocks in general were very high, and so is optimism. As we enter 2016, we actually see pessimism very, very high, and valuations coming something closer to something reasonable. And so with a 3% global growth rate we're expecting, we think it's a good year for stocks in 2016.
All of those points and more are going into how investors prepare for investing in the coming year. For Nightly Business Report, I'm Dominic Chu.